Hi, this is Anita from Real Estate Crunch. Today we're going to talk a little bit about mortgages because when most people buy a property, they will take out a mortgage, which means that they will loan money from a bank or a lender, and then they will pay back with interest to the bank for their property. So first of all, what is a mortgage? A mortgage is a loan that helps you buy a house or property. You borrow money from a lender and repay it over time, typically 15 to 30 years with interest. The mortgage type you choose affects your monthly payments, total cost, and financial flexibility. So let's talk for a minute about the different types of mortgages. The first one is the fixed rate mortgage. Fixed rate mortgage is a loan with an interest rate that stays the same throughout the loan term. The pros are that, it's predictable monthly payments. You know what you're going to pay every month. It's protection from rising interest rates, and this is usually a great one to get if interest rates are low, and then you can get a fixed rate mortgage. That's usually a great mortgage to be able to get at that time. And it's great for long-term house owners. Cons are you have higher starting interest rates compared to adjustable rate mortgages, because if the mortgage rate goes down, you're not going to get the lower rate. And it's best for buyers planning to stay for long term. They want to have stable, type of payments every month. They want to know exactly what they have to pay every single month. An adjustable rate mortgage is different than a fixed rate mortgage, and it is as the name applies. It's also known as an ARM or ARMS. It is a loan with an initial interest rate that adjusts periodically after a fixed period. So it could be 5 years, 7 years, or 10 years. The pros are you can have lower starting interest rate, savings if the rate decreases. Cons are payments can increase if the rate rises, and uncertainty in the long-term cost. So you really don't know what the long-term cost will be. There can be some uncertainty there, and it's best for buyers planning to sell or refinance before the fixed rate period ends. Then there's the FHA loans, which is a government-backed loan for low to moderate income buyers with low credit scores. There can be a low down payment as low as 3.5%. It's easier to qualify for with lower credit scores, and it's competitive interest rates. Cons are it requires mortgage insurance, so you have to buy a mortgage insurance for it, and loan limits may not cover expensive homes. So it's best for first-time buyers or those with limited savings or lower credit scores. A VA loan is a loan backed by the U.S. Department of Veteran Affairs for eligible veterans and active duty military members. There's no down payment required, no private mortgage insurance, and competitive interest rates. The cons are only available to veterans and service members, and funding fees may apply. So this is a great one if you are a veteran or an active duty military personnel. This could be a great loan for you to get. There's a USDA loan, which is for rural and suburban buyers meeting income requirements, backed by the U.S. Government of Agriculture. The pros are, again, there's no down payment required, low interest rates, and flexible credit requirements. The cons are they're only available in eligible rural and suburban areas, and income limits apply. So buyers in rural areas with limited savings, this could be a good loan for you. The last one is called jumbo loans. Jumbo loan is a loan for properties exceeding conforming loan limits set by the Federal Housing Finance Agency, the FHFA. Pros are allows financing for high-value properties and has competitive interest rates for qualified buyers. Cons are stricter credit requirements, higher down payments, and interest rates. It's best for buyers purchasing luxury or high-value homes. So those are the basic mortgages which are available in a country, as this is specifically for the United States. So other countries may have something similar, or they may not have something similar. So interest rates is really what is the key in all of this, because the higher the interest rates, you will increase your monthly payments and total loan costs. That's why on the news you hear so much about what are the interest rates, lowering the interest rates, because whatever the interest rate is, it means that your monthly payments are higher. Lower interest rates can reduce your monthly payments and save money over time. And, fixed versus the adjustable rates. Fixed rates can give you more certainty, lock in your rate, while the adjustable rates can fluctuate based on the market trends. So, all of these are things that you need to consider if you're looking to buy property and that you need to understand if you're looking to be able to get a mortgage. We have written a blog post on this. If you'd like to be able to read more about this, we have 15 frequently asked questions about this. And our blog post is called The Types of Mortgages Explained, a Comprehensive Guide. We will put a link for the blog post in the description below in case you'd like to be able to read more. Thank you so much for listening and being part of our community. We truly do appreciate you. If you haven't yet, press that subscribe button. We'd love to have you join with us. Thank you so much.